Okay, guys, you should be able to see my disclosure. Bear with me if you, hopefully you do. Let me know if you don't. If FX Street can let me know. Okay, great. Well, slide is on, disclosures up. Let's go through that really quickly then, guys. This presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products may involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, are not available to US residents because of regulatory reasons, guys. So hopefully the one other caveat I need to add to this, guys. Unfortunately, my Forex.com charts aren't working today. I've tried to fix them; they just haven't worked. But I will show you my Bloomberg chart. So just to reiterate that all charts that you see, the prices aren't reflective of prices that we offer here at Forex.com. Their prices are they're from Bloomberg. Okay, let's quickly move here, and that's the quote of the day. Now, Alan, you're right in there. With comments you want all the majors. Let's start with Kiwi because it's kind of interesting. Today it had a really sharp move higher on the back of an unexpected upgrade to its credit rating outlook by Fitch, which is a rating agency. It's had a big push higher. It's pulled back a little bit today. It had got above 88. It's pulled back as you can see today. It's now trading 87.84. But it's looking very, very strong. And if we manage to get above that 88.10 level, daily close either today, maybe tomorrow, I think that we could all of a sudden get very, very really accelerate on the upside. Now, the high that we're looking at right now, the next key resistance level is 88.43. That's the highest level from August 2011. And the reason why I mention it is because if you go back even further, this is some of the highest at that level. That level from August last year was the highest level since 1981. So as you can see, it's quite a big deal. It is, it's pushing higher, much stronger. That's on the back of, well, two things really: that relative interest rate differential that we've been talking about for a while now. So the RBNZ, the hiking interest rates, the economy seems fairly good, and then on top of that, you've got like a credit rating upgrade. That's kind of fuel to the fire. Obviously, the reaction so far has been fairly muted. Alan, you're saying you don't expect the RBNZ to raise rates again. We do. We're expecting one more rate increase. You don't have a position in Kiwi, and you've sold your Aussie at 95, which I have short. Yeah, that's a good idea, but you probably sold it at a good place. You probably locked in a lot of profit. So sometimes you just got to kind of change your direction. But obviously, the Kiwi is looking very, very strong now. Alan, since you have mentioned the Aussie, let's take a quick look. Obviously, it did have quite a strong reaction, which is possibly an understatement, to those NFPs from last week. As you can see here, we had been as high as, let me just zoom in a bit on here. We had got above 95 at one stage last week, and then we fell off very, very sharply. In fact, this was the post payrolls move, which took us down to over 150 pips lower then. We've clawed back some gains today, but really until we can get above that pre-payrolls, that high from before the payrolls, so at least at 94.50, it's probably not going to look fantastic. So we are watching it. Yes, it could pull back. We've got some economic risks coming, or some fundamental risks, I should say, coming up for the Aussie. We obviously have the Chinese inflation on Wednesday. That's going to be really critical. But also, you've got to look at the dollar side of things, right? Because the Aussie sold off very, very sharply on Thursday, because of that, what was going on with the dollar. We have FOMC minutes on Wednesday. That's going to possibly direct what happens with the dollar for a while now. certainly the medium term outlook for the dollar, we think. And in medium term, I'm probably talking quite short term here. I'm talking in terms of the, few days a week. John, you want me to talk about oil and gold? Yes. Euro, where's it going? It's stuck. Yes, I completely agree. And I think, that's really what we're seeing here with the Aussie as well. It's a little bit stuck. And I think until the RBA actually come out and say, yes, we're going to hike interest rates. Yes, we're moving to a slightly, we're going to follow what the Bank of England do. We're going to follow what the RBNZ does. I think we're going to have a struggle with the Kiwi. Obviously, the downside is capped by that 50-day moving average, that nice pink line under there. That comes in at 93.41. But then the upside, obviously, is this high. So you're looking about 95.11. Now, on that note, John, let's take a quick look at euro. Yes, it's completely stuck. We have heard that there are some fairly big option expiries, one at 137, one at 135, which is possibly why we've been trading in that range. If I just bring us back down here, as you can see, absolutely trading sideways. Now, this is an Ichimoku cloud chart, so we're still below the cloud, which is essentially we're still below the cloud, which is essentially, a sign that we're not in an uptrend, that we're still in a downtrend, that things are quite negative. I agree with that. I think that for us to, yes, we made a big stab higher, but we faltered at that 137 level, which suggests to me that, yes, these option expiries are critical. We have to get above that 137.13 level, which is this orange level here, the base of that daily Ichimoku cloud, before we think we can see a sustained move higher. Otherwise, we just think we could be moving absolutely sideways in this range. Now, in terms of, fundamental things that could move us one way or the other, considering it didn't move us one way or the other, considering they didn't move them one way or the other after the payrolls or even after the ECB meeting, really, what's the chances? What's going to push this? This cross? I think the most powerful fundamental reason for it or the fundamental driver of the euro, I should say, is going to possibly be a mixture of ECB officials wanting and European officials, European government officials wanting a weaker euro, combined with the dollar finally moving higher. Now, you've got on the one hand, the European economy, yes, it's improving, but arguably weaker than the US economy. Maybe not at the start of this year, but from, it's only rising from a very low base. You've got the US economy creating lots of jobs. You've got, a fairly healthy outlook there, and yet the euro is still managing to cling on to gains against the dollar. We continue to think that there is a downside in the euro, and that this kind of range is going to be short-lived. We're smack bang in the middle of it now, really. 135 was the low, as we said. We think that there certainly is potential for some downside. 135.84 has held right now. That is a key level, actually. That is a 61.8% retracement of the latest recovery. So that recovery from mid-June to early July. So we've managed to hold above that level. So that's kind of something just to, take note of. I suppose it's quite normal to hold there. The MACD, which I can't show you right now, but it is below the zero line, which suggests that the momentum is falling. That was triggered again on Thursday, sorry, about that NFP report. And then we have a kind of resistance again, which is that 137 level. It's a July 1st high. And that comes ahead of 137.48, which is a 50% retracement of the May to June sell-off. In fact, I will actually draw that in for you. Let me just get my tools one moment. So yeah, 137.48, 137.5, basically. That is the kind of next major resistance level. But as I mentioned, we are managing to hold on at that 135.84 level, that retracement of the latest recovery. And that by latest recovery, I mean from here, from June 11th all the way to July 1st. And we'll be watching that quite closely to see what else comes of it, basically. Okay, so I'm going to leave euro here from where we are. I think we can all kind of understand, what's going on. John, you just mentioned, is the dollar for real? Are we going back down? I think that's what we don't know right now. That's why we have to wait. It's one of those things. We think that there's a good chance that euro should fall, that could resume its downside. But we do, a daily close below that 135.84 could take us lower, could take us down to kind of 134.77, which is the low from February 3rd. And then 132.48 is the 38 retracement of the July 2012 to May 2014 bull trade. So, and there's quite a lot of resistance from where we are here. But we think there's a higher risk of further downside, largely because obviously the economic differentials, the fact the ECB is on hold. It just seems to us that the market is ignoring a few things right now, and that at some stage the Fed is going to have to really show their colours and really have to start hiking interest rates, and that is something that could that's the time probably when the euro is going to really fall. But in the very short term, obviously a break below 134.84. 135.84, sorry, could take us down to 134.77. So watch out for that. Now, I know some other people were looking at dollar CAD. This could be an interesting one. Obviously, on Friday, we get the minutes. From the we get the labour market data from Canada. That is going to be. That's always quite an interesting one. That can be quite an erratic data series, really. As you can see here, we've jumped above jumped above 106. Now this is significant. Again, I'm looking at Fibonacci here. Let me just draw it in for you. Basically, we had some very bad data out of Canada in the last few days. And if we get a bad labour market report on Friday, now remember this labour market data out of Canada can cause a lot of volatility in dollar CAD, but it can also be a very volatile series. So you tend to have 1 month where it does well, the next month it doesn't do well. And my colleague Neil Gilbert wrote about this in our week ahead. I'll tweet you a link later or send you a link later. But what he kind of mentioned is that, if we get back to that 106 level, it could attract a lot of buying interest. Now we seem to have kind of jumped well above there. We're above 106.88 at the moment. This opens the way to 107.30. So that's the 50%. It was the 50% retracement of that move. So of that September to March advance. We've sliced through there on the back of the GDP revision. Do you remember that? When there was a large GDP revision, US growth nearly fell. Well, I think it was minus 2.9% for the first quarter. That was when we just sliced through all these kind of key former support levels. Well, they're now acting a bit as resistance levels because the dollar is coming back on that turn in Canadian data. So that's certainly something worth watching there. And again, those of you who are trading CAD, I think that labour market report is going to be the most important. Obviously, the Fed minutes as well. But it seems to me like the market is protecting that 106, that downside level, that 61.8% retracement of that September to March advance seems well protected in my eyes. 107.30, as I said, is the 50% retracement. That's your next level of resistance. They could just provide a bit of stickiness if we were to get there ahead of that labour market data. So watch out for that. Obviously, if we get a good labour market data, we could really retrace maybe back up to the 108 handle. That would be kind of where we were looking, certainly in the short term. The 108.05 happens to be the 200-day moving average, which is going to be a key level of resistance as well. So please do watch out for that one. The other, what else did you guys want? So Alan, hopefully that works for you. You're currently long dollar CAD from from 107-ish. Okay, that's an interesting one. So you got long a bit earlier, so you maybe have had to wither some pain. I think there's a good chance it could get back there, but as I said, you may have to wait to really extend your gains until Friday and we get that labour market report out of Canada. Obviously, the caveat being that if you get a surprisingly good number, that could weigh further on dollar CAD, if that's what the market's focusing on at that time. Okay, all right. So someone was looking for gold. Well, I did speak to my colleague Fawad, who is the main one of us who looks at gold, and I just talked to him about it. He doesn't feel as bullish as he did last week sees a break of 13.10, opening back to kind of almost to that 12.90 level. So this 50-day moving average here. So as you can see, we tried to make a run for it, but we really traded sideways. Tried to make a run for it around about the 19th of June, and then we just traded sideways. That does, I mean, that suggests that there's maybe a bit of fatigue in the bulls, that they're waiting for the next driver, but also possibly that it wasn't the kind of push higher that we'd all expected. So do watch out for that. As you can see, there's a lot of support on the downside though. We've got 1304, that 100-day moving average, and then we've got that 1290 to 1280, 1290 to 12 or 1285, sorry, 1290 level, which corresponds with 200-day and the 50-day moving averages respectively. So basically just these lines here, as you can see, they could protect downside. A lot of people in the market, particularly on the 200-day, they look at that quite closely, so they will be watching that as we go forward. I just don't really think there's any driver one way or the other. Obviously, in the near term anyway, the thing that could drive gold are two macro events. Firstly, on Wednesday night, we get the FOMC minutes. If these minutes suggest that actually the market, the Fed are still very dovish, we think there's a risk that maybe the minutes will almost leak or almost give away the fact that not everybody is as dovish as Janet Yellen on the Federal Reserve. Well, if that doesn't happen, then we could see gold rally as people start worrying about inflation in the US caused by monetary policy being too loose. Likewise, we get some inflation data out of Europe. Now, that could be the thing that could potentially weigh on the euro, because obviously weaker inflation, gold is an inflation hedge. If inflation is very weak, then you don't need it. So that certainly hasn't helped. So every time, we see for example, last week with the ECB not doing very much, again, that can hurt gold because, it suggests that we may not be able to generate inflation for some time yet. The other thing that I was going to mention, someone asked about oil. I have to say, yet again, not really my forte, but I will take a quick look at it for you here. I will also send you a link to our quarterly report, because I think you guys would find that quite useful. Just bear with me here, guys. Just bear with me, I'll just send you this link. There's some great oil stuff, great gold stuff, great stock stuff. So all lots of kind of interesting bits. There you go, that's the link to our Q3 report. Hopefully you find that quite a good read. But anyway, sorry, yes, so this is Brent. I'll look at Brent right now because obviously it's open. I know the US is open as well, but it does tend to be European oil. It can be slightly interesting. Like we said, really, yesterday or last week, I think I was saying that we expected to get down to the 110. Well, now it's broken that. It's gone sliced through its 50-day moving average, continues to give back those gains, and it's really gone back to its range. So it just shows that spike higher on the back of those fears about what was happening in in Iraq really were short-lived, and as those problems have calmed down, the markets have kind of retreated very, very sharply. Now we are approaching some key support, and I think certainly in the next dollar or two, people could say that maybe we've priced out enough, and maybe the downside will come to an end. So I would say I'd be a little bit cautious. I wouldn't look for I'd be certainly cautious on the downside. The 200-day moving average is going to be significant, 109.05. We're currently trading 109.60. That is a level that is watched by the market. So as you can see, I would expect that certainly to hold, or if we were to go any lower, I think 108 would act as good support, and that corresponds really with the prior low ahead of what happened in Iraq. Now we might not get, obviously there are residual problems in Iraq, and we would still urge caution that if you are concerned, or if there is another kind of blow up of events there, that we could see, a sharp reversal in oil, with oil being one of the prime beneficiaries of what happens in the Middle East right now. So there you go. So we were kind of right on our call of oil that it was going to moderate some more. Yes, there are lots of geopolitical events going on in the world. For right now, though, the world can carry on as normal. Oil is getting shipped around the world without too much disruption. And some Libyan suppliers come back on board. So that's another key driver there, which obviously the more supply there is, that takes the edge off the price. So hence why we've seen that kind of fall a little bit. Great. So I'm pleased that you all like our quarterly. Please do read it. I have to take a couple of other questions. One thing I'm going to show you obviously is cable as well. Cable fell off quite sharply today on the back of some quite dismal production data. It's been erratic, the production data. I think the market's possibly overreacted a little bit. The production data on an annual basis is still looking fairly good, really. Added to that, it can be a volatile. The survey data suggested that it was strong, should be stronger than this. Sometimes, obviously, the survey data lies. But sometimes the actual data just needs to play catch up. So we will be watching that. Obviously, it was May data. There were 2 bank holidays in May that could have hurt the capture of that data. So all of this stuff could have weighed on that data figure. So I don't put too much stock by it. I just think that we need to just bear it in mind. Obviously, the pound is very sensitive to economic data. It personally, it's rallied very, very hard over the last year on the back of better than expected economic data. So it's not unnatural to expect it to fall off quite sharply if we get a data miss. But I would actually say industrial production and manufacturing production data, which was kind of 2 months ago, sorry, is fairly out of date right now. So that's one thing I would watch. As you can see, if I just go onto an intraday chart, we did dip all the way down to, what was the low there? 70.86, after reaching a high of 171.48. And we've managed to claw back from there. I think that was this 170.80 to 90 level was used as a good buying opportunity, really, by a lot of people. So that's why I kind of think that that it's doing that. Cable is still looking quite strong, and is still there's still potential for some upside there. Just looking at what else could or where this could go next, I think the focus is still the same, right? If I go back to my annual chart, that's a really nice, just even looking at that pattern, it's a really nice uptrend. I think the focus is still on that 173, 173 32, which is the 50% retracement of the November 07 to January 9 bear trade, and that's ahead of that obviously you get 75, but I think the focus is still on there. I don't think anything's really changed. The fundamental outlook still looks quite good, and we also have we had some very good June PMI surveys, so maybe this is just a blip. We do know that production data can be quite a volatile series. Dollar yen as well. I'll take a quick look at dollar yen. Dollar yen obviously not been very interesting. As you can see, it rose on the back of the NFP report. Since then, it's fallen off. It's below its 200-day moving average, which comes in at 101.82. Very disappointing reaction, I think, post those payrolls. But obviously, there's Japanese data to consider as well, which is getting better. We did see kind of momentum rise on the back of last week's move higher, and in the very short term, we're still obviously range bound, but we would look to remain above 101.22, which has held as good resistance for some time. Obviously, that's the focus now. If we get below there, that's going to be very, very bearish. Could take us all the way back down to 100, that big round number. So for us, yeah, it is disappointing that the dollar's not rallying, not gathering strength yet. Maybe the Fed minutes are what's going to turn this around, but also what's weighing on the yen. I will just very quickly draw. Create a chart for you just to show you what it's up against, because a lot of people ask me, a lot of clients ask me, why hasn't it rallied? Well, it's got a lot going against it, certainly from a technical viewpoint, which is which could go some way to explaining something, why it's so stuck. But it is very stuck, and it's the most boring pair. Now, I want you to concentrate. In fact, I'm going to take off one of these lines. It's just confusing. I'll talk you through that. But basically, here is dollar yen and the Nikkei. As you can see, very, very strong correlation. The dollar yen traditionally got a very strong relationship with stocks. It tends to move alongside the Nikkei. The Nikkei massively underperformed, started picking up quite strongly in May. And then it started to kind of the relationship with dollar yen really kind of reignited. But we've turned lower in the Nikkei overnight. That's also weighed on dollar yen because of that traditional relationship, really, nothing more. And if I just bring you up another chart for you, obviously I know some of you have joined my webinars, you know what we talk about. There's a lot to do with yields and currencies and currency values. Well, yield, as you can see here, treasury yields, this is a 10-year yield. It had been moving higher, it's since fallen, given back some of those gains. But even if I go to a 2-year yield, which is considered more sensitive to kind of interest rate changes, etc., we had moved to a 3-year high in this yield, but we've backed off those highs. And again, that's just that has just weighed on it as well. So it was 3-year, by the way, intraday high, not this chart is just a last price chart. But as you can see, it's just backed off those highs, which is also weighing on the yen. So, guys, I'm going to have to leave it there. But thank you so much for joining. It was a great half an hour. Really good to get so many of you having questions and putting them up. Please do join next week. It's always good to have you guys. And have a great trading week ahead and good luck. Thank you, everyone.